welcome back. Today's video is all about the option Greeks. I'll start by defining each one. I'll then break down the function of how the Greeks work individually. I'll provide examples on how they affect option contracts. And lastly, I'll show you how to apply the Greeks in Thinkorswim. So let's go ahead and jump into it. So I want to start by prefacing this video by going over how option contracts work so that there's no confusion. I also want to emphasize that some of this content may be a bit complex to start, but I will make everything make sense by the end of this video. Alright, the first thing to know is that one option contract is equivalent to 100 shares of a stock. So on the screen, you see the first example. Let's say you were seeking to buy an option contract for 1.5. In order to get the dollar value, you need to multiply by 100 to get the option's value price. So in this case, if you were to purchase this one contract, the cost would be $150. So if there was to be a 50-cent change in the option's price, this equates to either a $50 gain or a $50 loss, depending on the direction of the stock. So these are just the basics. So now that we have that context of understanding, let's dive into the first Greek, which is delta. All right, to start it off, the delta projects an option's price change to a $1 shift that's relative to the stock price. So all in all, what this means is that the delta measures the sensitivity of the motion of the option as the stock price moves. Now, call options and put options have different values of the delta. Call options reflect a positive delta, while put options reflect a negative delta. So now let's look at the ranges on a scale so that you guys can see the correlation and hopefully it makes sense. Okay, so call deltas again are positive, so they range from 0 to a positive 1. On the other hand, put deltas are negative and range from 0 to negative 1. But it is important to note that deltas do not remain constant. They do in fact change because we know there's so many variables in the stock market. So I just want to be clear that these are not set to fixed values. But let's take a look at a delta, call, and put example so that you guys can see this with real numbers. So on the screen for this call example, we're going to say the delta is at a positive 0.50. If the stock price rises by $1, the option price will increase by 50 cents. But if the stock price falls by $1, the option price will decrease by 50 cents. So moving on to the put example, you'll see this transversely. Okay, so the same variables are true, but again in the opposite direction since they are negative. So if we start with a negative 0.50 delta and the stock price increases by $1, the option price falls by 50 cents. But if the stock price decreases by $1, the option price rises by 50 cents. Now, this is confusing. Trust me, I will make it make sense in just a second. I know the Greeks are one of the hardest concepts to understand as a beginner trader, but I'm going to break it down with like contract numbers, so just bear with me. But let's look at how this ties in with the gamma so that I can fully show you how they function. All right, the gamma works side by side with the delta. What the gamma does is project an estimation on how the option's delta will change relative to a $1 shift in the stock price. So let me show you an example of what this looks like. If you have a positive delta on a call, let's say it's at 0.50 and a gamma at 0.05, what this means is that if the stock price rises by $1, the underlying call delta is now 0.55. But if the stock price falls by $1, the underlying call delta becomes 0.45. Again, I'll tie all of this together in just a second to provide more clarity, so no worries. But let's move on to theta real quick. Okay, now let's discuss theta. I will say theta is the easiest Greek to explain because we all know how valuable time is. So the technical definition of theta is the measurement on how much a contract's price will lose value after each passing day. Hence why theta is referred to as time decay. But to put this plain and simple, theta is the sentiment of don't play with my time. Like, just don't. Now, because theta is relevant to swing trades, as more time goes by, time decay accelerates because the contract gets closer and closer to the expiring DTE. So now with this example on the screen, let's say the option contract is $100. If the theta is at a negative 0.02, the daily depreciation equates to $2. So if you were to hold this contract overnight, your day one ending value would be $98. And after day two, the contract's value would now be $96, and so on and so forth. So now y'all see why I said theta is the definition of don't play with my time. because theta is the erosion of the value of your contract over time. Oh, and again, keep in mind, these factors are assuming all things remain equal, including the stock's price and implied volatility. And speaking of implied volatility, let's go ahead and dive into the next Greek, which is Vega. Okay, so Vega. Vega is one of the option Greeks that I feel gets ignored often, but it really shouldn't be. Honestly, it's a Greek to really pay attention to. What it does is estimate an option's price change based on a 1% shift in implied volatility. So you may be wondering, like, what exactly is implied volatility? All it really is the expectation of a stock's price to change, and supply and demand are primary factors of implied volatility. Now, there are certain other elements that affect implied volatility as well, and I'll save that for a future video. But the important function of Vega is the change of measurement. So now let's take a look at an example. So for instance, if the Vega on a contract is at a 0.25, if the implied volatility increases by 1%, this corresponds to the options contract rising by 25 cents. And the opposite is true as well. If the implied volatility decreases by 1%, the option price is expected to fall by 25 cents. Along with that, one thing to keep in mind is that the higher the implied volatility, the higher the option prices become because of the inflated movement. So in turn, premiums become more expensive. But if the implied volatility is lower, the option price falls because of the deflated movement. So premiums become less expensive. So again, this may be confusing, and I'll bring it all together after I discuss the last Greek. So let's go ahead and hop into Rho so I can make sure that all of this is going to correspond to make sense for you. So Rho. This is the least discussed Greek of them all. Very rarely will you hear anyone talking about it, but what it does is measure the sensitivity to interest rate changes. So it's a reflection of how an option contract will either gain or lose money based on a 1% change in those interest rates. So the important thing to note about Rho is that it considers risk-free interest rates. Again, this is relative to the market. Also keep in mind that Rho is positive for call options and negative for put options. But Rho isn't a Greek that I'll spend a lot of time on. Not to say it's irrelevant, but if you're swing trading, it's more important rather than day trading to consider Rho. So with that being said, I'll just go ahead and tie everything together and then we'll hop in Thinkorswim. Okay, so let's take a look at a contract example using Apple. Let's say, for instance, the share price is trading for $149.15. And let's say you wanted to put in a play for calls at a 150 strike. First thing you need to look at is the bid and the ask. In this case, the bid is at 2.15, which equates to $215, or the ask price would be 2.18, which equates to $218. Now, of course, you always want to consider implied volatility, the volume, and the open interest. That's always going to be key factors in whether or not a contract is worth your while. Now, on the right side of the screen, we see the Greeks, of course. The delta is at a 0.50, the theta is at a negative 0.25, and then the gamma is at 0.05. We're just going to focus on those three right now, okay? So at the bottom right, we're going to go ahead and review what everything looks like. The contract price, again, would be $215 if you buy the bid. The delta is going to be $50. So let me pause and explain what this means. This means incrementally, if the stock price were to move up $1 amount, you would gain $50, okay? Now, if it does that incrementally, then of course you have to also add the gamma because they go hand in hand. So what does this mean? It means you would increase your profit by $55 per contract that you put a play in with this particular example, okay? So let's look at a 155 call. That way you guys can see the differences. But keep in mind where the theta is for this 150 call. You would stand to lose $25 per day if you were to swing trade this contract overnight. And again, that would essentially depreciate each and every day that you hold the contract. So let's look at an example for a 155 call. Okay, so with this example, we see things are varied quite differently. We see because this isn't exactly in the money, the 155 call obviously is a little bit higher, but the bid price and the ask price are going to be the two major differences along with the Greeks as well. So we see the bid price is going to be $90, the ask is $88. Implied volatility, volume, again, keep all those key factors in mind. But let's look at the Greeks. If you were to buy this particular contract, we're going to look at the delta, we're going to look at theta and gamma as well. So at the bottom right, you would spend $90 to buy the bid, so $90 for the contract. And then you would stand to gain $20 if the stock were to move up $1 incrementally, and then of course adding the gamma in as well to include that. So you would have a $22 profit per contract if you were to hop into this play. Now some people are like, okay, well, what's the difference? Why does it matter? It really just depends on your trading strategy. So you see where the theta is for this 155 call. It's essentially you're only going to lose $15 a day, right? So you're not losing as much money because this particular strike price is not within the money so close. That 150 call was closer, so that theta is going to erode much, much faster. And you can see that, right? This is like a general example, but it's very closely related to what you would see on the chart. I wanted to show it in this way just because the display of it is easier to read. I know sometimes when we look in Thinkorswim, it's just a bunch of numbers and it kind of just looks all jumbled up and kind of crazy. And if you're a new trader, that can be really, really confusing. So I wanted to break it down in these simpler terms. Okay. So now let's think about it in these terms. This is where strategy comes into play. If you're seeking just to day trade this stock, then you may not be too concerned about paying the $215 for the 150 call because you're not holding the stock overnight. So in this case, the theta would be irrelevant. But if you are seeking to swing trade, or if you want to purchase more contracts at one time, then the 155 call may be more appealing. And these are just things to consider. But if you look at the 150 call, the delta and the gamma is higher. So you of course stand to make more money. And of course, these contract prices, with it being higher, it only makes sense that way, right? So we're looking at the 150 call. Oh, and another thing I do want to note, this is for beginner traders. Please do not ignore implied volatility, because if the stock begins to trade bilaterally, meaning it consolidates, when you get stuck in these contracts, you're literally just stuck in the contract and you may lose money. More than likely, it's going to happen if you get stuck in a contract, right? Because it's just like a pointless trade. Not always, but most times. So bilateral trades don't play in your favor. So always pay attention to the volume when deciding on the best contract. And keep in mind that staying within the money is very, very imperative. So I say all that to say, just do what works best for you. And then, of course, what makes sense for your desired outcome. If that's getting more contracts at once because of the quantities, then do that. If you're more of a reserve trader, then be that. Either could work for you if done correctly. So just keep all of that in mind. So I hope everything makes sense at this point. What I'm going to go ahead and do is now hop into Thinkorswim. Now that it's like more clear and concise, we'll see what this looks like on the chart. So let me show you a few examples in Thinkorswim. All right, so I have QQQ pulled up here on the chart. The first thing I want to show you how to do is obviously pulling up the option Greeks on the option chain. That way, prior to making a play, you know exactly what to expect as far as your profitability. And then also you can anticipate if the play goes against you, what you stand to lose. So in order to pull this up, the first thing you need to do is click on the options tab right here in the middle. And now you'll see on the left side, there's a list of the weekly contracts. And then on the right side, you see the percentages with the plus or minus. And this just simply tells you the implied volatility. So let's go ahead and take a look at June 20th, which you see the DTE is set to 2 because these contracts will expire at the end of 2 trading days. So I'll hit the drop down for June 20th. And now you see the focus is on the bid, the ask, the mark, and the percent change. And if you hit the gear icon above the strike price right here in the middle, you'll now see the columns editor pull up. And under the hidden columns, you just need to search for the Greeks and then hit the green plus, and they'll be added to your option chain. So the first one I see, of course, is delta. I then see gamma. I'm going to scroll down. I'm going to skip Rho just for this video. And then I also see the theta and the Vega. Now I'm going to scroll back up, and to keep the chart as clean as possible, I'm going to take off the percent change, and you can just hit delete. And there we go. Now we have all the Greeks pulled up on the chart. Okay. So from here, let's take a look at a few contracts just to see how they play out. Okay, so let's go ahead and focus on the calls to start. The first thing to note is that QQQ is trading at 485. So it's good to know the share price before you hop into any trade. So now we're going to go ahead and take a look. Let's say we wanted to make a play for obviously QQQ to go up maybe $1 to 486. So now let's go ahead and take a look at the bid price. Now we know the bid is going to be that 1.20, which equates to $120 for one contract. If you bought the ask, then it'd be $121. Now we see that the delta is at a 0.48, and then we see the gamma is at a 0.12. So what this means is that, of course, if QQQ does rise by that $1, you stand to make $48 per contract. And then of course you would have to add that gamma again once it, rises up. So you would have 48 plus 12, which is 60. So it's important to know you would make $60 per contract. Okay, so let's go ahead and take a look at the theta. We see the theta is at a negative 0.50. So this tells us you stand to lose $50 if you were to hold this contract overnight. So you have a $60 profit you could make, but you would lose 50 of it if you held this contract. This is why I say trading is very confusing for new traders if you don't break it down in these simple terms like this, because most people don't understand that. They think swing trading is a good way to kind of make money, but they're often entering into contracts that aren't going to be beneficial for them. Okay, so keep that in mind. So we see that this is going to be a play for calls. Now let's go ahead and take a look at the puts. Okay, so obviously if we're going to put in a play for puts, we're going to look at the stock declining. So let's go ahead and scroll up and let's take a look at the 484 strike price. We see that the bid is at a 0.90, which equates to $90. And then if you take a look at the delta, it's at a negative 0.32. The gamma is at a 0.08. So of course, if the stock drops by $1 to 484, we're going to have that $32. And then of course, adding that gamma once it makes that incremental move, you add those two together, that would be $40 you stand to make off a put play for QQQ. Okay, so these are going to be the factors that are so important to know, because oftentimes as a new trader, people don't break it down in these kind of like simplistic terms so that you can see exactly what you're going to gain and what you may have a possibility to lose. So always pay attention to the Greeks. Again, it's going to dictate your profitability. So I don't know why anybody would avoid looking at these numbers. Sometimes it's just hard to, break them down to, layman's terms to understand. But once you do know, you should not ignore them. Okay, so let's go ahead and take a look at a couple other different contracts so that you guys can see a different reference point. All right, so I'm going to go ahead and scroll back down, and I want to show you guys the value in buying in the money. So you guys can see, obviously I said the share price, you can see is 485 for QQQ. If you were to take a look at the bid price for the strike of 490, you see that the contract would only cost you $19. But look at the delta, look at the gamma, and I want you to take a look at the theta as well. Do you guys kind of see the trend in terms of how these contracts are broken down? Also take a look at the put side as well. Look at the bid price, look at the delta, look at the gamma. Again, do the math to make sure that whatever you have set for your trading plan, that any contract you enter would actually make sense, okay? So let me actually scroll down as well, because I want to show you guys what it would look like if you were to buy, let's say at the end of the month on the DTE for 10 days out. So I'm going to scroll down. Again, take a look, and we're going to keep it within the money for these particular contracts. Let's look at 486. Okay, look at the bid price, look at the delta, look at the gamma, and then look at the theta. Again, play these contracts to the best of your ability. Do not deviate from your trading plan. No matter who you hear any information from, stick to your trading plan, okay? So I'm going to let y'all just do the math on what you see. I know this video is already long enough, so I feel like I've provided enough value. And I truly hope that everyone has at least learned something that you may not have known prior to. And if that's the case, feel free to leave a comment down below. So yeah, that'll pretty much do it for this video. Thank you guys so much for watching, and I'll see you in my next one.